Hey scholars, we're now going to be looking at audit evidence and directional testing. You may recall that during our regular lecture series, we told you about vouching, which is going down, and tracing, which is going up, right? Very, very simple ways to remember those. But what was the purpose of them? You may recall that we created the financial house. It started with original transactions. It came to books and entries and ledgers and trial balances in the financial. There's your financial house. What we want to do is we want to be concerned about overstating good things, assets, revenue, overstated, or bad things being understated, bad things being expenses and liabilities. So if we're worried about overstatement, we vouch down. By vouching down, we're looking for support. Think about somebody on the roof, a contractor building a house, and he's looking down. He wants to make sure that this roof is supported below him, that there's existence of that foundation. On the other hand, with items that we're worried about understating, like expenses and liabilities, we're going to grab documents from original sources and we're going to trace them up. And think about that same contractor. He's building the house, he's on one of the floors and he's looking up. What's he looking for? That the roof covers everything, that we have complete coverage. No rain is going to get in. So complete coverage is what we're looking for, that they're not understated. So we trace up in that manner. Easy way to keep in mind what the purpose of the audit step was and which way you should go if they ask you how to prove something. Well, let's go on a little bit further. You'll note here we have some interesting items. Examples of directional testing for expenditures. Now remember, with expenditures, we're going to trace up. So in this particular case, we have some information. And we have the accounting records. You'll note we have the current liabilities way at the top of this particular item. We actually have the current liabilities at $30,500, and we have the accrued liabilities. You'll notice we have a requisition, the purchase from blank t-shirts. It was delivered and it was for $15,000. We also have the invoice, which is total due is $15,000. Nathan, the senior auditor, starts testing by selecting some supporting documents. You'll notice this then goes into a journal entry. We notice that it was a debit to inventory and a credit to accounts payable to record the purchase. We then can see in this particular case, Nathan verified the purchase is recorded as a journal entry. Then we can see that the subsidiary ledger included that within the body of it, so it's part of the elements. Nathan verified that the journal entry is properly posted, and he makes sure that everything is footed. We then note that the general ledger also has this, so Nathan verified that the total from the subsidiary ledger is included into the general ledger. From that point, we go to the trial balance. And you can see just a small little fraction of the trial balance is there. And yes, within that is the $30,500. The $30,500 was the total accounts payable. And we know that the total accounts payable included the $15,000. So Nathan verifies that the total from the general ledger is included in the trial balance. And then from there, we go all the way up to the actual balance sheet. And Nathan verified that the trial balance agreed to the financials and looks like everything was included. So there's your directional testing, going from the source document up to the financials to make sure it was included, right? That there was total, complete coverage of those potentially understated items. And with that, hopefully you've got a better understanding and you're ready to work some problems.